Welcome to Objective 6 in Unit 6 of Accounting 3310. We're discussing revenue recognition, and we're ready to look at the two particular methods of revenue recognition that are used when there's a lack of assurance of payment. Revenue recognition presumes that customers who buy on account will pay. Some businesses go to extraordinary levels to check customer credit reports or even get references, but there are other completely successful businesses that even advertise no credit check and just show us your pay stub. How do accountants adapt revenue recognition principles when there is no expectation of customer payment? At the end of this objective, students will be able to recognize revenue when the company has no assurance of customer payment. The principle behind revenue recognition without assurance of customer payment is that we'll recognize revenue when collection actually occurs whenever there is no assurance of collection. The pattern used for recognition differs depending on the method used, the installment method or the cost recovery method. Companies can use either one of these methods, and there are no particular criteria to separate using one method from the other. So this is a little bit like choosing depreciation methods. There's a free choice between these two methods. Let's first start by talking about the installment method. This method is used for tax purposes and also provides a somewhat faster recognition of revenue. In the installment method, one recognizes the portion of each dollar received as gross margin on installment sales based on an annual gross margin percentage. The basic formula is the gross profit realized is equal to the cash payment received multiplied by the gross profit percentage in the year of sale. Let's take a look at some actual numbers to see what this means. Let's say that our company had installment sales just in 2003 and allowed customers to pay over 2 years. So some of the payments are in 2003 and some in 2004. To use the installment sales method, we need to know what the gross profit margin is for the year in which the sales take place. For that information, we need to calculate the gross margin. Gross margin is sales less cost of goods sold. So here, the gross margin is $400. That $400 of gross profit divided by sales calculates the gross profit percentage. So 400 divided by 1,000 is equal to 40%. Now, knowing what the gross profit percentage is, we can calculate how much revenue is recognized in each period. Let me say that more precisely. We're going to calculate how much gross profit is recognized in each period. So in 2003, we receive only $100 from these customers. 100 times 40% is equal to $40. And so $40 of gross profit in 2003 will be recognized and increase net income. In 2004, we received $900 in payments. 900 times 40% is equal to $360. So altogether, we knew that if all of our customers paid, we'd have $400 of gross profit on these sales. The installment sales method divides up the recognition of that $400 based on proportionate to the cash actually received. Here are the journal entries that would occur using the installment sales method. One is going to have to track the installment sales separately from cash sales or other sales in the company. So when there's a sale made that's going to use the installment sales method, we'll put it in a separate revenue account, and we have to track the cost of goods sold separately. So I've established an installment cost of goods sold account. When we have collection, we're going to be recognizing the increase in cash and the decrease in accounts receivable. At the end of the period, we're going to calculate what the total gross profit on installment sales is. We close the installment sales and the cost of goods sold account and recognize a deferred gross profit on installment sales. Here we have a credit of $400. That deferred gross profit represents a liability because we haven't yet earned that gross profit. At the end of the period, we will now identify how much of that $400 can be recognized in this year. Our calculations on the previous page said that in 2003, $40 of it could be recognized. So we decrease deferred gross profit on installment sales, and we increase gross profit realized on installment sales. Deferred gross profit account is kept for each year in which installment sales are made. As an adjusting journal entry, a portion of that deferred gross profit is recognized each year until installment sales are either fully paid for or written off. That deferred gross profit is a credit balance account that decreases accounts receivable. It's a credit balance account that represents amounts owed by customers that the company doesn't expect to receive. As cash actually is paid, the deferred gross profit account decreases and gross profit is recognized. Let's take a look at a multi-year example of the installment sales method, in which we have installment sales taking place in each of 3 years, and the installments are owed over 3 years. So, in 2002, we have $100,000 of installment sales, and looking down to cash receipts for 2002 sales, we see that the cash came in $50,000 in 2002, $40,000 in 2003, and $10,000 in 2004, which fully paid those installment sales. In 2003, we had installment sales of $150,000, and if you look under cash receipts for 2003 sales, we had cash coming in of $75,000 in 2003 and $30,000 in 2004. This is not fully paid. There'll be more cash coming in 2005. If we look at the 2004 sales of $180,000 and then under cash receipts for 2004 sales, we see that there's $130,000 in cash that came in during 2004, and the remaining $50,000 is going to come in 2005 and 2006. To begin this method, we start by calculating the profit margin percentage for each year's sales. The gross profit percentage in 2002 is the gross profit, which is the difference between revenue and cost of goods sold, divided by the sales. So there's a 40% gross margin percentage in 2002. In 2003, we had $150,000 in revenue minus $105,000 in cost of goods sold, and we're going to divide that by revenue. So our gross margin percentage in 2003 has declined to 30%, $45,000 divided by $150,000. The gross profit percentage in 2004 is based on its revenues and cost of goods sold, which is $60,000 gross margin divided by 180, or 1/3, or 33.33%. Now let's calculate the profit for each year. We're going to be calculating the profit separately for each year. In 2002, all we have are the sales from 2002, in which we received $50,000. 40% of that $50,000 can be recognized in 2002, so we have a gross margin recognized of $20,000. In 2003, we have customers paying on this year's sales and last year's sales. The $40,000 that came in on the 2002 sales is associated with the gross profit margin from 2002, and the gross profit margin for 2003 is associated with the cash received on the 2003 sales. We can't just multiply it by the 2003 gross margin percentage. So here I calculate each year's cash receipts separately, add them together, and get $38,500. In 2004, now there are 3 layers of cash received. I have cash received on the 2002 sales, on the 2003 sales, and on our current 2004 sales. I use the appropriate gross margin percentage for the year in which the sale took place. So I'm adding up figures from the gross margin for 2002, for 2003, and for 2004, and get $56,333. Cash received generates the recognized profit. We're going to match the year of the original sale with the year of the profit margin percentage in order to get an accurate figure of how much to recognize. Do not use the profit margin of the current year with cash associated with sales from prior years. The journal entries are going to recognize the sales and the cost of goods sold at the time those sales take place. Those accounts are then closed to deferred gross profit. There'll be a deferred gross profit account for each year in which there are installment sales. Then, at the end of the year, we'll decrease the deferred gross profit account and recognize gross profit on installment sales. The installment sales method matches the method that's most commonly used for tax purposes as well. It also is a relatively rapid recognition of revenue, given that no revenue is recognized at the time of sale. The disadvantage here is the information processing. We must calculate a new gross profit margin each year, and we have to maintain that information going forward until that year's sales are fully paid for. We may recognize gross margin we may recognize gross margin later that may need to be written off. That is, we'll go ahead and recognize revenue on sales for a year, even though they're not fully paid for yet. So it's possible that we will have to reverse ourselves and write off some accounts. Now let's look at the cost recovery method. This method is a somewhat slower recognition of revenue, but it matches the theory behind waiting until we have an assured payment somewhat better than the installment sales method does. The principle here is that we recognize each dollar of cash received above the cost of installment sales as gross profit on installment sales. Profit recognized is equal to the cash received minus installment cost of goods sold. A cumulative total of cash received is kept by year in which the installment sale took place. No cash is recognized until the installment cost of goods sold is recovered for that particular year. Therefore, every dollar received is recognized as installment gross profit. Let's see with numbers how this differs from the installment method. If we have a similar example in which we have $1,000 of installment sales, $600 of cost of goods sold, and we receive $100 in payments from customers in 2003 and $900 in 2004. This method says that no gross margin is going to be recognized in 2003. We will not recognize any revenue until we receive more than $600 from our customers. The first $600,000 from customers goes toward paying for the goods that we provided to the customer, and only the next dollar, the $601st, is actual profit. Let's take a look at our solution. When we account for the cash received, there's $100 of cash received in 2003. The cost of goods sold not yet recovered in 2003 is $600. When I subtract 600 from 100, I get negative 500. So I know that there's no profit to recognize yet. I don't have a positive number. So the profit recognized is 0. In the next year, cash received is $900, and the cost of goods sold not yet recovered is the $500 that I calculated in row C in the previous year. I have to receive another $500 before I can recognize any gross margin. I subtract that $500 from the $900 I received, and I find that I've received $400 in above the cost of goods sold, so my profit recognized is $400. The journal entries are going to be similar to the ones that we've done before. We record the sale at the time it occurs and then calculate deferred gross profit and recognize profit out of that deferred gross profit each year in an adjusting journal entry. Now let's take a look at a cost recovery method that goes over all 3 years. If we have installment sales similar to before of $100,000 in 2002, $150,000 in 2003, and $180,000 in 2004, the 2002 gross margin of $40,000 will only be recognized when I've received from the customers more than $60,000. Notice that that does not occur in 2002, so there's going to be no revenue to recognize in 2002. In the next year, when I get $40,000 of payments on the 2002 sales, now I have fully recovered the installment cost of goods sold from the 2002 sales, and I can begin to recognize revenue. Let's take a look at the kind of analysis we'll need to do. I've laid this out in a table again. We know what the installment sales and cost of goods sold are each year, and I need to calculate what the installment sales are for each period. The cash received on 2002 sales is $50,000. The cost of goods sold that I need to recover is $60,000. So in C, the difference between the two is negative $10,000. That means I have no profit to recognize, and I write a 0 in row D. In 2003, I receive cash of $40,000, and I need to recover another $10,000 of cash in order to cover my cost of goods sold. $40,000 minus $10,000 is $30,000. That's how much I've received over and above installment cost of goods sold, so I'm able to recognize $30,000. In 2004, I have already fully recovered cost of goods sold, so when $10,000 is received, I have no cost of goods sold yet to be recovered, so 0 from 10,000 is 10,000, and I can recognize the last $10,000 of profit. Now, I have analyzed how the profit is going to be recognized on the 2002 sales. Nothing in 2002, $30,000 in 2003, and $10,000 in 2004. To calculate the profit to recognize in each year, next I'm going to step up and recognize how much profit on the 2003 sales will occur. Let's go to the next slide and take a look at this table. Now, I'm going to examine the 2003 sales, and they hadn't happened yet in 2002, so there's no profit, of course, recognized then. In 2003, I received $75,000 from customers on their 2003 sales, but the cost of goods sold in that year is $105,000. So $105,000 taken away from $75,000 shows that I have a lack of $30,000 that I have to recover before I can recognize any profit. So because I have a negative number, my profit recognized is 0. In the next year, I received $30,000, and that's exactly the amount that I must recover in cost of goods sold before I can recognize any profit. So even in 2004, I subtract 30 from 30 and I get 0, and there is no profit to recognize on the 2003 sales, either in 2003 or 2004. Let's go to the next slide and look at the analysis on the 2004 sales. In this year, I have to recover cost of goods sold of $120,000, and in this year my customers pay $130,000. So my cash received is $130 minus the cost of goods sold yet to recover of $120 gives me cash above cost of goods sold of $10,000, and I can recognize $10,000 on the 2004 sales in 2004. Let's gather the information together now into a single table from our analysis of the sales of each of these companies. Pulling the information from each of the last 3 slides. In 2002, there's no gross profit to recognize on the 2002 sales, and the 2003 and 2004 sales are irrelevant to 2002 gross profit. So there's no gross profit realized on income in 2002. In 2003, bringing forward the information, I have $30,000 in gross profit recognized on the 2002 sales, none on the 2003 sales, and it's not relevant to examine the 2004 sales. So $30,000 is recognized in 2003. In 2004, I have $10,000 of profit pulled up from the analysis of the 2002 sales, nothing from the table on 2003 sales, and $10,000 on the table for 2004 sales, for a total of $20,000 recognized in 2004. Sales that take place in each year must be segregated and analyzed separately, and then added together to find the gross profit on installment sales in a single fiscal year. That is, in 2004, there's a contribution from 2002 sales, 2003 sales, and 2004 sales. To evaluate this method, the cost recovery method matches well with the underlying principles of recognizing gross profit only when received from customers. It's a slow recognition of revenue which encourages risk management by companies. The disadvantage here is that you must keep track of that remaining gross profit to recover for each year's sales. So there's a relatively high information processing cost burden. This is the end of our discussion of the 2 methods that are used to recognize revenue when there's no assurance of payment.